Monday, 17 August 2026. 3 Asia-Pacific AI stories before your first coffee. Hanoi's Decision 33 took effect on 15 August, making Vietnam's list of 46 high-risk AI systems a binding legal category that carries conformity assessment and notification duties for operators. Transport dominates the list, covering 31 of the 46 systems, with most operators facing a compliance deadline of March 2027, and healthcare, education, and finance sectors given until 1 September 2027. The move lands in the same week that Thailand closed its public hearing on a draft AI Act modeled on the EU's risk-tiered framework, and South Korea's National Assembly is one plenary vote from passing a bill that would let AI developers train on personal data without consent. Why it matters? Southeast Asia now has its first enforceable high-risk AI register, and the transport-heavy tilt means logistics platforms, autonomous vehicle developers, and fleet management vendors operating in Vietnam need to start scoping conformity assessments now, not next year. Builders across the region should watch the staggered deadlines closely. The March 2027 transport cutoff will likely become a de facto template that Thailand and other Asian regulators reference as they finalize their own frameworks. For capital allocators, the compliance burden creates immediate demand for third-party testing and audit capacity, which is why Singapore's AI tester accreditation program, standing up this quarter with no fees, is worth tracking as a regional infrastructure play. The second-order effect, if Korea's personal data bill clears its floor vote, the regulatory gap between data-liberal training regimes in Northeast Asia and risk-heavy compliance regimes in Southeast Asia widens further, forcing multi-regional operators to run split governance stacks. So, SK hynix posted second quarter revenue of 79.32 trillion won, with a 76% operating margin, as operating profit surged 557% year-on-year, driven by insatiable demand for high-bandwidth memory chips from American hyperscalers. The same supply squeeze is hitting the other end of the value chain hard. Indian smartphone shipments fell 11.1% in the latest quarter, while average selling prices climbed to a record $315, with phones under $100 collapsing 74.3% to just 4.5% of the market. TrendForce forecasts conventional DRAM contract prices rising another 13 to 18%, and NAND up 10 to 15% in the third quarter. Why it matters? The memory shortage is splitting Asia's tech economy into winners and losers along the same supply chain. Korean and Japanese memory makers are printing historic margins, while device assemblers and consumers across South and Southeast Asia absorb the cost. Long-term agreements between SK hynix, Samsung, and American cloud buyers now lock in volume and cap quoted prices, which pushes smaller Asian OEMs and regional cloud operators further back in the allocation queue. China's YMTC holds roughly 13% of global NAND shipments, and CXMT around 7% of DRAM. But new Korean and Chinese capacity is not scheduled to come online until 2027, so nothing material loosens supply this year. Capital allocators should watch whether Indian handset brands accelerate their shift to mid-range lineups, effectively abandoning the sub-$100 segment that wants to fund the market. Now, Singapore dominates Southeast Asian AI funding so completely that the rest of the region barely registers. Truxin data shows cumulative AI startup funding across Southeast Asia at $9.3 billion, over 261 disclosed equity rates, with Singapore-registered companies accounting for virtually all of it. Vietnam sits a distant second at $19 million. In 2026 so far, AI startups have raised $4.1 billion across 23 rounds, more than double the $2 billion raised across 41 rounds in all of 2025. Though Clean AI's $2.8 billion Series D accounts for roughly 68% of this year's total. Why it matters? For builders and capital allocators outside Singapore, the numbers can form a structural concentration problem rather than a regional boom. Seed funding rose 68% to $328 million, which is healthy, but Series B remains a visible gap, meaning startups that survive early stages still struggle to scale without relocating or redomiciling to Singapore. Deal count actually fell to 127 rounds from 153, even as rounds above $100 million tripled to 12, signaling that capital is consolidating into fewer, larger bets. Regulators in Jakarta, Hanoi, and Bangkok who want domestic AI ecosystems should note that policy incentives alone have not shifted the graph.
the second order effect to track, whether Singapore's dominance starts pulling founding teams out of neighboring markets entirely, hollowing out local talent pipelines before they mature. That is your AI in Asia briefing for today. Stay sharp, build well, see you tomorrow.